Hi, my name is Celeste Smith with REMAX Associates, and this is John Thomas, my lender partner, with this week's update.
Welcome to the Delaware Mortgage Rate Weekly Mortgage Market Update for the week of June 16, 2014. Hello, I'm John Thomas with Primary Residential Mortgage, here to give you an update. Well, last week mortgage rates did move lower, but then at the end of the week were able to stabilize and rebound off the low. If you take a look at the bond chart on the screen, you can see the trading pattern for the last 2 weeks has been for mortgage bonds to sell off, move lower, which has moved interest rates slightly higher. Still at historic lows, but moved slightly higher. But then on Thursday into Friday, we did get a recovery. We were able to hammer out a bottom of support, and the technical trading pattern there looks like mortgage bonds could rally and bounce higher, moving interest rates lower. So we're going to recommend floating your Delaware mortgage rate to start the week to see if this technical trading pattern can hold and see a bounce in the mortgage bonds. Now, what helped us at the end of the week to stabilize, and it looks like we're ready for a rebound, was some economic news that came out last week. We had two reports that were disappointing, which helped mortgage bonds. The first one being retail sales for May 2013 came in at 0.3, which was lower than the 0.7 expected, and this is the lowest retail sales reading since January of this year. Now, retail sales make up 1/3 of all consumer spending and is the main driver behind economic activity in the United States. So in order for economic recovery, retail sales need to grow. So that was not a good number. Remember, bad economic news helps the bond market. And then the second report that boosted the mortgage bonds on Friday was the consumer sentiment, coming out worse than expected, 81.2 versus expectations 81.9, which shows consumers aren't feeling as good about the economy as we thought. And we also saw a third report last week that helped mortgage bonds as well. And on Friday, that was the Producer Price Index, the PPI. For May, it dropped 0.2% versus an expectation of increase of 0.2%. Now, the Producer Price Index is a measure of inflation. So inflation's been running hot, which means it's been heating up. So this report shows that inflation actually has turned the corner a little bit and is going down. So that was good news for bonds in the inflation. And then Thursday, we saw the release of the weekly initial jobless claims, which ticked up to 317,000 claims for the weeks. Now, claims have been inching up lately from the lows not seen since 2007. The labor market is still cloudy as we finally recovered all the jobs lost in the last recession, but the number of jobs recovered doesn't tell the full story because we still have 3.6 million fewer high-paying jobs in the manufacturing, construction, and government sectors than we did before the Great Recession. So even though we've got the same number of jobs back as before the Great Recession, the job makeup is totally different. We recovered service sector jobs, not the high-paying jobs, which is not good for the economy. And then in housing news, Realty Track reported there were a 5% drop in all types of foreclosures from April 2014 to May 2014. And there was also a 26% drop or decrease in foreclosures from May 2013 to May 2014. So this is good news in the housing market, showing that we are still on the track for recovery. So that's great news. Now, in the local news, the next free first-time homebuyer seminar is Saturday, June 21st in Newark, Delaware at the Christiana Hilton Hotel from 10 a.m. to noon.